Hello, hello. Welcome to the Five Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. Hello, hello. Abel Pacheco here, your host for the Five Talents Podcast. We're just super excited today to really have a couple of fun guests. Already, we've had a little pre-show conversation, and I can tell this is going to be a fun one. A great group of guys, $50 million assets under management for Park Ave Capital, and Chris, an attorney, a mediator, served in the Army, Collin, main partner there, and just owning, operating properties, Bricktown Management, and you guys are doing deals. I'll let you, basically talk about the background, but for the listeners, I wanted to, make sure that you understood that, having, $50 million, 750 units plus under management, you've got a very good perspective of how things operate, how to partner, how to go find deals, how to get deals done, how to raise capital. So there's a lot of nuggets that are going to be highlighted today, and it's just a great team, great group. So Chris, Collin, let me turn it over to you. Give us a proper introduction. Tell us about you guys, your company, and what you do, and then we'll just dig into what you're doing today.
Go ahead, Collin.
Perfect. Yeah. So just a little bit of background on myself. Was basically raised in New Mexico, graduated from University of New Mexico, got my bachelor's of business there, moved out to Nebraska, started working in retail, then got a 9-to-5 job after I got my master's degree. Started working in project management, in IT project management for an insurance company. Quickly found the purple book, Rich Dad, Poor Dad, which I try to leave out, but I can't because that was kind of a pivotal moment. January 1st, 2017, I read that book. And from there, just a light bulb went off, realized that there's such thing as leverage, and that there's not just the appreciation, there's not just a 401k out there. There's actually other ways to build wealth, much exponentially faster than the traditional models that 99% of the population associates with building wealth, building a retirement. Bought a threeplex, quickly started buying more. Honestly, I don't think I've gone a day since then without having a property under contract. There was actually close to 24 hours, and about 10:30 at night, I had signed a contract on a 23 unit. So I made sure that I didn't go a full day. Ended up starting a property management company called Bricktown Management, which handles a portion of Chris and I's assets for Park Ave Capital. Chris and I decided to partner. We focus on joint ventures as well as syndications. We have some active partners. We have lots of passive partners. We focus on assets in the Midwest. We really like the Midwest, not only being from the area, but we focus on forced appreciation rather than the market's doing well, S&P is going up, Dow Jones is going up, so our property's going up. We really focus on increasing income, reducing expenses. And yeah, we're at $50 million of assets under management. We have 3 properties under contract. 2 of them were fully funded, a 72 unit in Sioux Falls, 64 unit in Tulsa, and then just got another 60 plus unit in Sioux Falls under contract 24 hours ago. This is December 4th. So yeah, that's just kind of a quick background.
All right. That's awesome. How about you, Mr. How do you pronounce your last name right? Pomerleau? Chris Pomerleau?
Pomerleau.
Perfect. Okay. Mr. Pomerleau.
quick background. I don't know how quick that was, but
Colin's not a talker. That's what actually right before we got started, he goes, Chris says, I'm the talker. And nope, Collin, you
Yep.
were, man.
Collin took it over.
We're 1 minute in. That was my only 1 minute. So I have to take it when I can.
Too funny. Too funny.
I mean, look, everything he said is accurate for sure. I mean, Collin got into the real estate the same reason I did, and I was looking for passive income. When I got out of the military, I already had my law degree. I could already practice law in 2013, so I started practicing law in 2013. I got a good job. I made good money, but I quickly realized that that's just not the way to go. When I stopped working, I stopped earning money.
Mm-hmm.
So.
Mm-hmm.
I wanted something to supplement that. I want to get to a point in my life where I can do what I want. If I want to continue law, I can continue law. But if I want to build things out of wood, then I can do that. I can do whatever I'd like. So, that's in 2013 when I started investing. And what we like to concentrate on is to build for that passive income, because if you have that passive residual income, then you can do whatever the heck you want. And so we quickly learned after a couple small projects, I wouldn't say quickly, it took me 4 years, 2013 to 2017. But after some small projects of decent cash flow, but single family homes, duplexes, 4 units, we learned that scaling this to much larger complexes really made the most sense. So that's when we just started tackling these things. And when we decided to partner together in 2017, we just find ourselves competing over too many properties. So we decided to team up. Collin has a great property management group. He started that same year. It's built into quite the company. And we look to partner with people throughout the country now and take down assets that allow us to make indefinite income.
I love it. I love it. Well, there's so many areas to jump into, but let's really talk it about today. So today you guys, and Chris and Collin have done a number of podcast interviews. So if you really want to hear more about their background, their story, how they got here, go check it out. Google them. You can definitely find more than a few. But on today's show, let's just talk about what you're doing today, right? So you have a couple of projects that are under contract. Your capital raised, I heard. You're right. We're recording in December. It'll air in January. So whatever you're comfortable talking about at this point, like tell us about today.
Well, we can talk about them all, that they're full funded, so we're not on here soliciting anybody.
Perfect.
Yeah, I mean, we're really excited. A couple of things we're doing here. First off, we're closing on a Sioux Falls deal. It's a 72 unit in Sioux Falls, South Dakota. It's a fantastic market. A lot of people don't know about it. It's only 2.5 hours north of us. We're right here in Omaha, but great value add opportunity. Rents are 20 to 30% below market. We can add laundry actually into about 80% of the units. We're going to replace all of the water, the toilets and the sinks with, the toilets and the faucets with water conservation. So that'll help us trim a lot of fat there on expenses. And basically our goal there is the next 3 to 5 years is to refinance the deal, pull all of our original capital back out, give it back to our investors, and they still stay in on the deal. So after that, they're into the deal for $0 or close to, and they continue to receive residual income. That's what we're doing in Sioux Falls, but that's actually what we've done. That's been our plan for all of our deals. And we've done that full cycle now 20 times.
Got it. So you guys have gone full cycle on 20 deals. For the passive investors, or what does that mean? That means they've acquired, they've bought, they've basically went into the longer debt, were able to take out or pull out their investor money, put it back in their hands, and at some point, full cycle, hey, we're exiting whatever the strategy like Chris is talking about, and have completely turned over 20 times, 20 deals, and that's just an amazing track record. What number of years was that? Did I hear? I was maybe confused. 2014 or 2017? When did that track record start?
It was about 2017. And just to clarify, when I guess our full cycle and what we say, because maybe there's full cycle and then there's second full cycle. Our full cycle, and what we consider that is the refinance of getting 100% of our capital back out. Our goal is always 80%, but 20 of those deals we've gotten 100%.
Man, that's so cool.
Much larger percents than that.
We've gotten
back
up to
out.
150% of our money back before.
Yeah, I love it. I love it. And for the listeners, for those that are single family kind of backgrounds, it's like a big BRRRR strategy, right? Buy, renovate, and then you refinance, and then you want to go put money back in your hands and then repeat. So just on an apartment complex. Yeah. One of my first deals was exactly the same. Was, we got it deep value add and kind of refinanced, and or the plan was to refinance and get all the capital back. But yeah, I'm with you.
Yeah, that's exactly what we focus on. As you said, it's like a big BRRRR deal for single family homes. Sometimes it may take a little bit longer, but not necessarily, since now we've built up some systems, et cetera, contractors. We can get into these places 6 months, 2 years, whatever the process is and whatever the lender will let us. But what I think has really set us apart, and there's a lot of people doing it, so I don't want to say we're unique, but maybe we're unique in the Midwest and the markets that we're doing it. We find these projects that, maybe have a $30, $40, $50, rent boost that we can foresee. However, there's also a RUBS opportunity. Lots of these places, maybe they're not instituting RUBS, but all of a sudden that's starting to come to the market around it. And the bigger apartments, they're already sub-metering for all their utilities. So we do the same thing. We do a bill back, we charge back, we look at what the utility charges, and we add that. And then from there, it becomes simple math. So we go in, we do the work, we improve the properties, we improve the exteriors, meet all the residents, fix up the maintenance issues from the previous property management. Typically there is, not all the time. Sometimes we're left with, better projects than others. But we're prepared for putting dollars into these projects, and that's factored into the deal. We're improving the services, we increase the rents. As I said, we reduce our expenses by billing back for, I guess, expenses that the resident is using. And it's, I don't want to say it's a secret model, but we just kind of look into it, and
it's a great
we
model.
underwrite things. Yeah, we found things on LoopNet, quite a few deals. They say LoopNet's where your deals go to die. Well, not if you get your price. That's the thing. And anybody can put out a price, but we can also put out a price and justify our numbers. And Chris does a great job of the underwriting portion. But if we justify our numbers, we get our price, and here we go. We do the same formula. We go in, and obviously there's certain things that happen along the way that are intangibles, but that's the basic process.
Yeah, let's dig in here, because I think this is a great show. In my opinion, I have a feeling we're going to give some of our listeners some really good nuggets and insight on how we create value in a property through increasing net operating income, through some of the basic tactics that we said, almost like a case study, if you would, on your individual properties. And so you did it 20 times. You have some insight on how to do it successfully, right? So the water conservation, that's one. The RUBS, which are ratio utility billing system, for those that didn't quite catch that. Then increasing the value up so that they can refinance and their created equity or created value in the deal. And there's enough to where I can pull out your initial seed investment so investors can invest again. And let's start there. There's a couple more things, right? But what is the ratio utility billing system, RUBS? What does that actually mean? So break that down so people get it, and then we'll go through like one of these at a time.
Yeah, so with ratio utility billing system, there's a couple ways to do it. Technically, that basically means when you look at, let's use, I have a feeling we make it into an actual case study, and let's use the Bellevue 36, Collin. But for ratio utility billing system, you have the opportunity to bill back the tenants. So most places, and I'm excited to get into electricity in a little bit, but most places have separate electrical meters for every unit.
Okay.
Not all, but most people do. So that means the tenant can just pay their own bill because they're the ones getting billed by the utility company. Many builds in the 70s, 80s, 90s even are picking up these, are only have one main meter for water, sewer, and gas. So the property as a whole has one bill for their water, sewer, and gas. It's only one bill for all we'll use a case study here for all 24 units, or all 72, all 87 units. We've seen this. So the ratio utility ability system says that, okay, we got that one bill, but as owners, we're not going to pay for your utilities. We're going to bill you back. And we're going to do that on a ratio perspective, or a path that takes it per how many people you have in your each unit, and what the square footage is of each unit, so that people aren't stuck paying more than they should.
Yeah, give us an example of the total bill for that water, like utility. How much does that property generate? And we'll back up into the numbers, right?
Well, I mean,
a rough idea. It doesn't have to be exact, Chris. Roughly.
For a 76 unit we closed on a couple months ago, we just paid about $3,000 for a water bill.
Okay, so this is so awesome. So even just here, let me explain this, right? $3,000 a month. How much of that did you give back to the renters to pay for? All of it or most of it?
All of it.
Okay, so $3,000 a month. Multiply that by 12 months. There's $36,000, right? And y'all's cap rate in your area is
about 6.5 or so, 6.5, 7 or 6.
So divided by, take that number and divided by 0.065. So 36 grand divided by 0.065.
$553,846.
So yeah, he knew that one. So you created hundreds of thousands of dollars of value just by turning that over, right?
Right. And what that doesn't take into, so that's a great example. And obviously the bigger the property, the more of a savings, the better it is.
Yeah.
Full transparency on that 76 unit, because we just closed it, we're slowly implementing tenants into that ratio. But you're right. Within 12 months. That's
the plan. I mean, it doesn't happen tomorrow.
Within 12 months.
Yeah. Perfect.
100%. So what's not talked about there is water conservation.
Yeah. Tell us about that.
So you can do a flat rate utility bill back. Instead of dividing it, you can just bill a flat rate. Now you're still trying to make it proportional, meaning it's a 2-bedroom, you pay $40, and if it's a 1-bedroom, you pay $20.
Sure.
But that overall bill is even less, right? So because we're going in there and we're changing out all of the toilets and all of the faucets. So on average, we're actually cutting our overall $3,000 water bill to $1,500, and you can do that within a few days. So then moving
do
forward
that immediately.
Yes. And then if you get that flat rate utility, it's certainly going to be 100% of it's paid off. And in some states, you're allowed to even make a little bit of money on that as well. Meaning, before there was water conservation, it used to be $100 a tenant. Now they only have to pay $60, and they're super happy because it's lower than you'd pay anywhere else in the area. But we as owners only have to pay $40.
Yeah.
So it depends on the areas. It depends on the jurisdiction. And so I would look into that, but that's just one way to cut costs.
Yeah. Beautiful. And, I was just talking to somebody else on water conservation, and we had somebody on our show, and they were talking about specifically. And what I forget about sometimes is we're doing this for profit. We want to make as much profit as possible.
Right.
But the good side is they were telling me that a leaky, faucet or whatever could leak like 100 gallons a day if it's, a rough leak.
Wow.
And if you multiply that by 87 units, that's a lot of wasted water. And really that's like, that's one of our most valuable, or if not the most valuable resource on our planet. And it's just literally going down, the drain, money, profit, and impact. So when you guys do this, there's an impact to it. And, maybe we don't factor this enough into our investments, but it's pretty cool. Like you're actually saving water. So water conservation on it, in addition to impact for investors. So that extra value, maybe you can explain too, since you're the underwriter, Chris, the net operating income, you've lowered your expenses, and that's why we're investing, end result, limited partners make more.
Well, I mean, we just crunched the numbers on the water. So even if we seriously didn't, let's just say we didn't build them back. Let's take rubs out of it. Let's just say we put on the water conservation.
Okay.
Our bill has gone from $3,000 to $1,500 a month.
Okay.
And now we're still making that difference. We've raised the value of the property $500,000. And that's our goal here, is raise the value of the property, make money, like you said, refinance and stay in it long term.
Yep. The water conservation, just cut the number in half. Like you said, if it's $1,500 and you just did that, maybe the property already had rubs. Maybe another property you already, buying is already doing the part of it, but you do the water conservation, $1,500 a month times 12. What is that? 18 grand divided by 0.065 cap rate. That's $276,000 of value you've created. And, you have to subtract the money that you're investing into the, with the toilets and that kind of thing, but it's like, it's worth it. We're going to do it.
Yeah. We've seen about 16 to 40 months it takes to get your money back. And it really is dependent upon how many 2 and 3 and 4 bedroom places you have, because that's more and more toilets. And so it just takes a little bit more time.
Yeah.
It's certainly worth it. Now that's just water, right? We haven't talked about electrical. So
let's talk about that part. Yeah.
We've teamed up. Should I do this, or do you want to talk, Collin? Because I feel like
go for it. No, go for it. So yeah, I told you to keep rolling, but you're on a roll, man. Keep going.
All right. Well, it's the same concept. I didn't know this until recently, and we teamed up with a good group named ZNE Capital. Owen Barrett, Nico Suazo, and Joel Caesar. They have a great background in solar energy. They've implemented and installed solar energy in different buildings. Yes.
Nice.
And so we have the capability now as a team to go out and find apartment complexes that only have one electrical meter. So instead of an electrical meter for every single unit, there's only one electrical meter. And the reason that's important, that's certainly more of a 60s, 70s, 80s build. But the reason that's so important is because now you just do rubs with electrical, and then you can install solar and save around 50 to 60% off that total bill. It's the very same concept as the water. It's just a different utility. And if you can do both of them, which we're doing in Tulsa right now, you can raise the value of a property so quickly.
Tell us, can you give or share off the top of your head, like some numbers around that too?
Yeah. I mean, that's fully funded. So, we're buying that for $3.3 million. We're going to put about $800,000 into it. The solar system alone is about $300,000.
Okay.
But with the ability there are a number of positive aspects of solar. There's not just tax write-offs, there are tax credits. That's just dollar for dollar. Anybody can apply it.
Yeah.
So it's not just that you have to be of a certain bracket or you have to have a real estate license or anything. It's nothing like that. You can actually just dollar for dollar get it. That's accumulated with it. And that's about $300,000. And then we'll put $500,000 towards upgrading the units, raising the rents, implementing rubs, just stuff like that. We anticipate that'll be worth over $5 million. I don't want to overquote it. It could be super high fours, but yeah, I think five. Oh my gosh. Actually, I think it's actually half five. So about mid fives.
Yeah. Yeah.
That's that turn, because of the situation, that'll take about only a year. Now we've informed our investors to plan on 24 months, because you never know what's going to happen. You need to be conservative. But if things go like we expect them to, in 12, 16 months, we now have all of our money back and we own a 64 unit in Tulsa.
Yeah, that's pretty dang cool. Yeah, and we get into those. That's where the old phrase or the saying is like, infinite return, right?
That's it.
Yeah, money back in and money's still working. Hello. You're listening to the 5 Talents Podcast. I'm your host, Abel Pacheco. If you're enjoying this podcast, then I know you're serious about achieving financial freedom. Are you ready to create your own path through multifamily investing for yourself and your family? Then I know you're going to appreciate our Investor's Guide to Multifamily Investing. It's titled Tackling Commercial Real Estate the Easy Way. We use this guide to invest ourselves in $93 million worth of real estate. So we're going to show you the basic mechanics of multifamily syndications and how to evaluate your next passive investment opportunity. So the best part, if you subscribe to our podcast now, leave us a review and a rating. I'm going to give you a free copy of our ebook. So please take a moment to do that now. Once you've done that, go to 5tcre.com/ebook, 5tcre.com/ebook. Make sure to let us know you left a review and we're going to send you a free copy. So thank you so much for subscribing to the 5 Talents Podcast. We really appreciate it.
a great
So
phrase.
how long do you guys say that, or to your investors, hey, you return capital, but how long are y'all going to keep them, or what are the investors in for? Are they planning to keep it forever, or do you guys tell them, hey, we're going to sell it in 5 or 10, or what's that look like?
Yeah, so I think what we try to do is we try to find people with the same vision as us, and I think it's similar to me and Chris and I partnering. We have become such a good partnership because we have the same vision. Have this long outlook. We are looking to build wealth. We are looking to build passive income. So we have the same goals. Well, our partners have the same goals as well. Our investors have the same goals. They may not be active in the project, but their goals typically are aligned with ours, and that's how we attract those investors. So what we are looking to do is we're looking to refinance, and we're looking to hold the properties forever. Now that's a fancy term of saying buy and hold forever. I'm never going to sell.
Yeah,
There's a
for a long
possibility we
time.
sell
Like buckle in.
for a long
It's a
time.
long
For a
time.
long time.
Yeah, I'm not going to
Yeah,
put a date on this thing. We're going to hold it for a while.
exactly. So if we buy this project for $3 million, $3.5 million, somebody comes tomorrow and says, "I'll give you $9 million." We're probably going to take that, unless we all of a sudden saw our money, inflation go up triple. We're probably going to take that because that's our fiduciary responsibility to give those returns. Otherwise, our outlook is to hold these properties as long as possible, cash flowing. You get the tax benefits. We're doing cost seg studies on all these properties, so we're reducing our tax liabilities. So yeah, our goal is to hold long term. I think everything eventually probably does sell, but we focus on the properties and the improvements that we make to the properties, such as doing these water conservation efforts. Those are costly. They cost something. We get it. We get almost immediate results on the NOI, but 14 to
Cash flow
40
for
months
a
later,
while.
yes, exactly. So we're looking at holding on to these assets for a while, and most of our investors, they want, what else are you going to do with your money? And once we sell it, then you get a big tax hit. So you're going to need to find another place to deploy it. So
Yeah.
we kind of see it if we have a good asset that keeps working.
Why sell it if you're just getting free cash flow?
Yeah.
Now,
Yeah. It makes perfect sense.
No guarantees, but if you get all your money back, it's free. You don't have any money into it. So so why sell it? And I know Collin mentioned we have a fiduciary duty to take it. So if we're all into a project for $6 million and someone comes along and offers us $10 million, it may not be a smart idea to pass on that. But our goal, and I think actually the reason we've been able to get from $400,000 in 2017 to $50 million and soon to be $63 million by 2021, January 1st, is we had those aligned interests with our investors. We're not just syndicating a deal and kicking you to the curb 2 years later. We're not refinancing you out and kicking you to the curb 2 years later. And there's nothing wrong with that. Many people make a lot of money. And by the way, many people like to have that large check in a few years, 3 to 5 years. And there's nothing wrong with that. But I think we've found that niche that people like to A, own real estate, B, they like indefinite cash flow, infinite returns, like you said, and C, they love it when they haven't put any money into it. And it's hard to pass on that. And so we haven't had a problem explaining that to anybody. Usually they're really surprised and happy we're doing it that way.
Yeah. Is that what differentiates you guys? Yeah, I think from a lot of the other teams, or?
Yeah, no question. We have to have these conversations with investors because we're doing our duty for these syndications to make sure we understand their background, get to know build that relationship, make sure they're comfortable with the project. And it's really surprising that most of them don't know about this. And there's no question, I think it's what sets us apart. That's why most people invest with us. They're pleasantly surprised they'll have an opportunity to not only invest in real estate, get cash flow relatively soon, and then get their money back and continue to receive cash flow. So that's certainly something, not to mention the water conservation sounds like a no-brainer. Not everybody's doing it, certainly not the solar. And another thing that I don't care if maybe we don't have to tell anybody this, but it seems like a lot of people aren't that interested in the Midwest. Good, we'll take it. And for some reason, Omaha, Sioux Falls, Kansas City is starting to blow up a little bit. Tulsa, these things within a 300-mile radius of Omaha, we can drive there hands-on. We know what we're doing. And it's a very, very slowly appreciating market that's not going to be highly volatile if something happens.
Yeah. Okay. Yeah.
And very business friendly. Lots of the areas that we're in are very business friendly. South Dakota with its tax laws. So, these are things that are often overlooked because I'm not going to South Dakota. I'm not going here. Fine. As Chris said, we will go there. These cities are flourishing. They are doing very, very well. And they are attracting talent. They are attracting Amazon fulfillment centers, multiple other, tech industries, et cetera, that are looking for either tax breaks or just areas with a little bit more stability where they're not going to have the rug pulled out from them. They're not going to be told to shut down their factories for 6 months and they can't go to work. That's not happening in the states that we're investing in.
Yeah, like them or hate them, there's a reason somebody like Wells Fargo put their main headquarters in Sioux Falls, South Dakota. It's because the tax laws are so friendly. It's very business friendly. There's a lot of movement there. And in fact, that Minnehaha County is the name of it. That county was the second fastest growing county in America right before the crash. The fastest growing was Henderson. That was Vegas, and we all know what happened to that. Nothing happened to Sioux Falls. It just kind of stayed stagnant and then jumped back on that gradual turn. So that's what makes us comfortable for sure.
Oh, that's awesome. I was going to ask you about the market mechanics because I don't know anything about Sioux Falls or Tulsa, but this gives me an idea. Last couple of things on the market questions are like, so you answered 6.5 cap for this B or maybe a C property. Give us some ideas or ranges, like how much are you buying the units for, like per unit? What's a per unit cost? What's an entry exit cap? Talk to us a little bit about the vintage that you guys are buying and the size of properties, just so I have an idea.
I mean, we're B and C class. We may find ourselves in some type of A class where we 1031 into it or something and just kind of park our end money there. But that's certain. There's not a lot of meat on the bone when you get to class A.
B and C, the cap rates out there for an A property?
We're low 5s, high 4s.
Okay, gotcha.
Yeah, people, they're always talking about Phoenix and Orlando, and yes, those are very low cap rates. But if you're getting Class A and stuff around the country, from what I've seen and where I've been looking, if you're getting that prime, you're gonna see really low cap rates that are pretty similar.
Yeah. And then the price you're paying per door on your current acquisitions?
40 to 80, and I know that's quite the span.
40 to 80, yeah.
That's quite the span, but it depends on if it was off market, if there's an agent involved, if we're able to talk in some seller financing, if it's a Class A or a Class B, it's location. But we're seeing 40 to 80.
And are y'all buying mainly from brokers, or do y'all do off market marketing, or what do y'all do?
However it comes to us.
So all the avenues, you do market, you do off market, you do go direct to seller, you do work with brokers.
A deal's a deal.
Partners.
Yep. Yeah. If it's off market and somebody who sent out postcards is hungry and brings it to us, we love that.
22 sounds like a number. You're like, well, you got 22 deals. You've found many different multiple ways to get them done, right?
That's for sure.
So on that, 22, so 22 are in process. They actually they're still under management today. Is that right?
So I love that you added 2 for us, and I really appreciate that. We've gone full cycle on 20.
20. Okay.
Yeah. And that includes, I think 3 of those have been sold.
Okay.
And if they weren't sold prior to the refinance, we just refinanced them, got all of our money back, started earning cash flow. And one of them's not the best example because it's only a 3 unit. So we wanted to get the greenhouse out of the way and go buy the red house. And that's why we did that.
Yeah, I gotcha. And then for your investors, the cool part about the money side is it sounds like you probably have a lot of the same investors again and again and again, because as soon as you put their money back in their hands, they want to put it back with you to do the next deal. Yeah,
exactly.
Okay, cool. How many, from an acquisition standpoint, maybe you could talk to us about like how much capital have you raised? How much did you need to go take all of that down? 50 million at 20% down, or are you guys doing LTV of 80, 20% or?
We are creative.
Oh yeah. Off the market, direct to seller.
Well, I would say that at best. I mean, we took it down. I mean, so here's
creative
the deal.
financing.
So
okay, cool.
We're talking about these bigger deals that we've done. I don't want to scare off anybody that's newer. There's a fourplex right down the street from my office we bought last week and already refinanced, and we're getting all of our cash back out with $100,000 of equity because we bought $100,000 off of day one value. So we are still picking up those things because those literally I can see it from my office window. Gosh,
Well, this is good.
so
No, let me pause you. I'm going to interrupt because I think this will help even our listeners say like, man, I want to go do what these guys are doing. I'm going to act there. Half of our listener base, I think, is also general partners active. They want to figure out how to go do their first, second, third, fifth deal. Right. And so just at a high level, talk about the numbers and the track record. You did a 4, an 8, a 12, a 15, go through those. How did the 22 evolve? And high level, it doesn't have to be specific, but
yeah, no, that's good. So I mean, we probably have 30 or 40 projects, 30 some. Lots of them are in flight right now in which we're refinancing. Those 20, 22. Chris has the exact numbers of how many we've done, the full refinance on. Well, I guess this fourplex is now going to be an additional one, and another one we have coming up next week. But yeah, I mean, I started off with a threeplex. Chris started off with single families. I bought a bunch of duplexes. I remember very clearly, and this is when Chris and I's partnership was getting a bit more serious. He brought a 24 unit. He found this off LoopNet, listed for 1.29. Everybody I knew looked at it. Garbage. It's terrible price. Just got it for $1,025,000.
Yeah, that's a horrible price. It's been there forever at 1.2,
yes,
but yeah, you didn't buy it at 1.2, baby. I love it.
Yeah, we got it for $1,025,000. So he was able to take up, $250,000 plus dollars. The neighboring building sold for 1.29. Yeah. The exact same building. That one sold because of somebody 1031ing into that. I believe is what was the case. But Chris kept working on this one. So that was kind of a big mind shift for us going to, that $1 million property. But yeah, sorry, I kind of forgot where we were going with that.
No, it's okay. This is good, Collin. Don't worry about it, man. All this stuff is going to bring value to somebody listening because, there's a number of deals, small deal, bigger deal, 1 point, whatever $1 million deal. And now that 22 is now I think are 36 and 87 or whatever, right? So it just kind of now is steamrolling into these much larger deals or transactions now.
Yeah, and we started, proving it to ourselves. I mean, kind of our financing at the beginning. We've done a lot of seller financing. We borrowed private money. I used the line of credit, home equity, and honestly, that money can snowball so quickly. So I love the idea of people jumping into big deals right away. But if it's your first one, there's a lot of risk to that. You're taking on other investors' capital. That's why it's not bad. When I'm looking at other deals, I'll invest passively. Chris invests passively. We will still do that if it's out of our niche range because we are looking for the professionals to handle that capital.
Cool. Active, the way I kind of always have said it, for at least for me, is I want to create as much active capital as I possibly can, whether that was in the years past in my W-2 job, making as much money as I could from a sales profession, commission. I earned it. That was active. If I stop working, it stops coming in, but it's there. It's active. Take active and push it to something passive. And if you can keep that cycle going, then whether you're, doing a 10 unit or a 4 unit or working in your W-2, it's active, put it in passive. And now you're starting to dig yourself out of that having to work mentality if you got enough created. And I really like that mindset for myself.
Yeah, and then you can do what you want. You can stay in that active role at your W-2. You can find a new W-2. You can do nothing. I mean, that's the beauty of the flexibility of earning passive income. Just do what you'd like.
Yeah, that's awesome. Well, while we're here, and so that I make sure I don't forget, where can our listeners reach out to you guys if they're interested in talking with you, investing with you, learning from you, one or the other? What's the best place to get in touch with you?
Our group is Park Ave Capital, not Avenue, but Park Ave Capital. Our website's parkaveinvesting.com. My email is chris@parkaveinvesting.com. Collin at bricktownmanagement.com. You can find us on LinkedIn, Instagram, Facebook. We have a free report we put out called partneringchecklist.com. You can check that out there. And we're always accessible in any of those areas. We like to talk. We like to speak with other investors, either really experienced investors or brand new ones. This is certainly something we're pretty excited about.
Yeah, that's awesome. Well, that's great. I do have a couple more questions for you before you go. So I don't want you don't leave just yet. If you could give our listeners maybe just a couple of actionable tactical steps to get started, that would be awesome, because we're hearing some great stories. We want to do something similar. We want to get after it. I don't, I've heard a bunch of podcasts like, what the heck do I do? What's my next step? What's the action? And everybody's got a different view. So we'd love yours.
I guess I'll start. So, I mean, and I just always look back to my experience in this is, first off, educate yourself. You're going to be surrounding yourself as you start to get involved in real estate. So say if you're day one, you know nothing, but you have a great career, but you want to get involved in real estate, start educating yourself and be relentless about that. Do it every day too. I think if you want to be really, really successful in real estate, focus on it every day, study, but also from a passive perspective, understand, have the understanding of the financial models, underwrite, sponsors, etc. So those are some of the things I think at the beginning. Understand your financials. Where are you financially? Are you in a financial place that, wow, I've got all this money over here, I really love my job, but gosh, the best year, the S&P 500 and my 401k is at 8%. But if I can go over here, and that's if you withdraw it, you're getting taxed upon that. However, if I invest in real estate, my returns can be much better. Just understanding that, not being blind to what your money's doing. That's just a couple quick hitters. Know what your money's doing, I would say, is a really good, and become educated.
Yeah, that's awesome. Thank you. How
Yeah,
about you, Chris?
I'd say just know your worth. Try to bring something to the table. I always hate the excuse that, I don't have any money, or I can't find any deals. You have something. You have a rich uncle. You have feet, so you can go knock on the door of the owner that owns the. If you don't have a feet, you have a phone. You can call the owner of an apartment. Maybe you have the ability to be a great property manager. Maybe you're great at laying flooring. And if you can find a way to team up with somebody and jump on a team and learn a little bit and learn this passive income, or at least offer something to get into this, that's what you got to do, because there's always a way to add value to somebody, and just know that you have that. Just find what that is.
Awesome. Thank you so much. I really appreciate your time. Is there anything else that we didn't cover today that you were hoping I asked, I just didn't get to? Something you want to bring some exposure to, or, last insights, or anything really? Time is yours.
I'll just go real quick. If you want to be successful in this business, and I'm not saying you can't be successful without doing this, it's just going to strain on you, is find a partner, find a mentor. And what I mean by that is utilize other people's abilities. As Chris just touched on, we all have some type of gift, some type of value which we could bring. Find other people's values, provide your value to that person, and they could reciprocate and bring their value back to you. Utilize other people. You will grow so much quicker. You will be so much happier. You will be doing the jobs that you like more often than the jobs or tasks that you don't like.
Awesome.
I second that. Well, both Collin and I have hired coaches. It doesn't even, maybe it's not even a real estate coach. Maybe it's just a personal growth coach, a strength coach, or whatever you want to do. But find a way to educate yourself, become better at what you can, and don't be afraid to admit you don't know what you don't know.
Yeah, I'm a big fan of coaches. I have a professional coach I meet with once a week. I have a real estate coach. And started really doing that the last year and a half. And when you start to measure success, you can measure it by net worth, or you can measure it by cycles or transactions. You can measure it by, some accomplishments, however you want to measure it. I can see a very measurable, significant positive impact from me hiring somebody, to either hold me accountable, train me, coach me, guide me. I'm 100% believer in it. So that's awesome.
For sure.
Right on.
100%. And they'll force you to write down goals. And you're typically, if you're doing it correctly, you're not going to accomplish all your goals, or at least in the time manner in which you expect. But yeah, I look back, I've got something over on my desk that, was goals that I set a year ago. Well, COVID really threw a wrench in traveling for a month and speaking at a conference. However, I had 5 other goals on there, and I was able to modify some of those goals that became unattainable and made them attainable. So it's nice to have them written down because it's in the back of your mind. And when something like COVID, whatever happens, you know that you have that goal in your mind. And although it may not be the end result you're expecting, you can find the end result that, becomes satisfying and honestly, in the end, better than what you were expecting.
Yeah. Love it. Well, thank you so much for a great conversation. I really appreciate your time. Chris, Collin, it's been awesome. I look forward to kind of continuing to follow you guys and your success and continuing journey. Your investors I'm sure are going to follow you too, and help contribute to all of your success as you give them back their capital, and they're going to get some more long-term deals. I love it. So congrats, guys. And thank you very much. My name is Abel Pacheco. I'm your host for the 5 Talents podcast. We would appreciate you going to our podcast, liking, subscribing, rating, and leave us a written review. That would be amazing. And that way we can get more amazing guests like Chris and Collin, and talk to you guys soon. And Abel Pacheco. Bye, gentlemen.
Thank you. Thanks for having us.
Thank you.
Appreciate it. Bye-bye. Thank you for listening to this episode of the 5 Talents podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who followed their dreams and achieved massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the 5 Talents podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked, tell us your favorite guest, give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the 5 Talents podcast.